In this week's video, we'll cover 8 new, hot-off-the-presses market studies to help us answer the question, how far could stocks fall in 2021 based on recent signals? In mid-April of last year, skepticism was still extremely high about a durable low being in place in the stock market. This table here appeared in an April 14th short takes post. You can find it by Googling this title here. This table helped us keep an open mind about much better than expected outcomes walking forward in the stock market, and it was based on a breadth signal from Nasdaq stocks greater than their 150-day moving average. This type of analysis can be incredibly helpful because it's factually based. It has nothing to do with personal opinions or personal bias. And it's incredibly helpful because the signal is based on something that happened in the recent past. So something that happened in early to mid-April of 2020. The projections help us understand how the past activity of some traders may impact the future activity of other traders. And as we know, future data did align with that April 14th short takes post. And all of this also aligned with the secular trend theory that was in place before the stock market peaked in February of 2020. Thus, if all of this is still in place, there are still certain things that we would expect to see in the present day. When we examine present day data, we do so in a similar manner by asking, does the present data, our most recent signals, does all of it align with or contradict everything that we've seen since the March 23rd low and everything before the March 23rd low? We'll be covering 8 signals and we'll be moving very, very quickly because we'll be summarizing the results at the end. Stock market breadth helps us track human behavior. This is the Nasdaq Summation Index. We have data going back to 1998. We're looking at all of it. Something that just happened on January 13th, 2021 has only happened one previous time, June 9th of 2003. Therefore, it might be helpful to ask and answer, how did the stock market perform walking forward from June 9th, 2003? It's also helpful to know what did the maximum drawdown look like over the next year walking forward from 2003. The first few weeks after that signal were a little bit rocky, but the maximum drawdown was incredibly muted, just a little bit over 1%, and that's using closing prices on the S&P 500. From the date of the signal, the S&P 500 continued to rally for over 4 years and tacked on an additional gain, not including the gain from the October 2002 low, an additional gain of over 60%. When we look at hard data, it's helpful to look at it from 2 perspectives. Number one, does something that happened in the present day, January of 2021, look like something that aligns with a bullish case? And it's also helpful to know that it really doesn't look like a major top in the stock market. When the S&P 500 peaked in March of 2000, where my cursor is, look where market breadth is here. Much lower than current readings. And it's declining into the peak. Here's the peak right here. It's getting worse. Similar situation. The S&P 500 peaks. This is a major stock market peak right here in October of 2007. Look at market breadth in the rearview mirror. It has been getting weaker for quite some time. This and this really doesn't look anything like this. And this looks a lot like this. This is the only reading that's similar to the present day. And walking forward from June 9th, good things happened for a long period of time and the drawdown was relatively muted. Signal number 2. Keep in mind the first signal was based on the Nasdaq Composite Index. This signal is based on the NYSE Common Stock Only Index. It's a volume-based indicator. It's the volume summation index for the NYSE Common Only. We have data going back to 2003, and we're looking at all of it. Q1 of 2020, very rare oversold reading, only seen 2008, 2012, 2015, 2018. And then we made it all the way back to the green line. That's extremely rare. It's only happened a handful of times. And in the 4 previous instances, good things happened in the stock market if you were patient about 100% normal and to be expected volatility that occurs even within the context of the strongest trends. It's also helpful to know what the maximum drawdowns look like in the S&P 500 from the date of the signal. This is the oldest signal that we'll be looking at. It came at the end of November of 2020. The S&P 500 was trading at 36.21, so these drawdowns are tied to this level here. After seeing a move like this in breadth, the drawdowns from the date of the signal were relatively muted, between 2 and 3%. Signal number 3. This indicator shows the percent of Nasdaq stocks greater than their 150-day simple moving average. We have data going back to 2002. We're looking at all of it. If you know your stock market history, if 2020 looks like 2002 Q4 and 2008 Q4 and Q1 2009, that's probably a good thing. And then when we add this move from here to here, it gets even better, because this move here and this move here were the only previous times where we saw something like that. And all of these studies speak to human behavior and human sentiment. When we're down here in October of 2002, everybody thinks the world is ending. The stock market will never be the same and the economy will never recover. Q4 of 2008, the world is ending. The stock market will never be the same and the economy will never ever recover. Sentiment was very, very similar. Q1 of 2020 at the March 23rd low, everybody knew that the world was ending, the economy will never recover, and the stock market will never be the same. And from the peak of pessimism here and the peak of pessimism here, the actions of some traders caused market breadth to improve rapidly, Something very, very similar just happened in 2020. It's the 3rd time dating back to 2002. In each case, we're trying to learn when market breadth moves from point A to point B. What might that tell us about the future actions of other market participants? Historically, other market participants continued to fuel a stock market rally, and in the 2 previous cases, the stock market was higher 1 month later, 3 months later, 6 months later, 1 year later, 2 years later, 3 years later, 4 years later, and 5 years later. The average gain from the date of the signal, 72.88%. How about maximum drawdowns? The 2 previous cases, extremely muted, less than 1%. The stock market, for the most part, never looked back. Signal number 4. Very similar setup here. We're looking at Nasdaq stocks, the percent of them greater than their 200-day simple moving average. After an oversold reading like this and moving back to this level here, it's only happened 2 previous times, right here and right here. And in the 2 previous cases, the stock market was higher 3 months later, 6 months later, 1 year later, 2 years later, 3 years later, 4 years later, and 5 years later. Average gain from the date of the signal 5 years out, 65.41%. And once again, drawdowns were relatively muted. Average drawdown from the date of the signal, a little bit less than 2%. 3 months out, 1 year out, a little bit over 2%. Signal number 5. This one was nailed down at year-end 2020. This is Nasdaq 100 stocks. The previous signals were based on the Nasdaq Composite Index. This is Nasdaq 100 stocks greater than their 200-day simple moving average. Similar concepts. This is a rare move. We saw something similar after the low on March 23rd of 2020. And in the two previous cases, if we look out between 1 month and 5 years, for the period shown on your screen, the stock market was higher in every single case. The average gain 1 year from the date of the signal, 15%. 3 years from the date of the signal, 33%. 5 years from the date of the signal, just a hair over 72%. And once again, drawdowns were relatively muted and they came relatively quickly. Roughly 8 calendar days from the date of the signal, the stock market dropped somewhere between 1 and 2%. Signal number 6. So weight of the evidence approach here, and it's noteworthy. This is now a different major index that we're looking at. This is the NYSE Composite, stocks greater than their 150-day simple moving average. Rarely oversold, very rare move. It's happened 2 previous times. We're looking at all of the data that we have going back to 2002. And in the 2 previous cases, this type of oversold reading here occurred near a major low in 2009 where my cursor is. This is the S&P 500. And near the major low that occurred in October of 2002. And once again, in the previous cases, walking forward from those dates, good things happened for a long period of time. The average gain 5 years from the date of the signal was a little bit over 65%. Drawdowns were relatively muted, less than 1%, and they occurred on average 27 days from the date of the signal. And that brings us to signal number 7. Weight of the evidence approach, noteworthy. This is a different index. This is large cap, S&P 100 stocks, greater than their 150-day simple moving average. Only seen a move like this 3 times in the last 19 years. And from a money management perspective, these signals are all very helpful because they're recent signals, meaning the drawdowns that we're calculating are very, very relevant to the present day as well as the projections. We hit the upper blue line on January 8th of 2021, similar to this point here and this point here. In the 2 previous cases, the stock market was higher 3 months later, 6 months later, 1 year later, 2 years later, 3 years later, 4 years later, and 5 years later. Average gain 5 years out, 68.25%. The maximum drawdown came 50 days from the date of the signal. It was 4.48%. In the other case, the drawdown was less than 1%, giving us an average drawdown of about 2.5%. That historically occurred between day 1 and day 50, or 26 calendar days from the date of the signal on average. Moving to signal number 8. Once again, looking at a different index. Strong breadth across the board. S&P 500 stocks, the percentage of them greater than their 200-day simple moving average. Hit this upper blue line on December 17th, similar to this point here in calendar year 2009, and this point here after the major low in 2002, and this occurs in here in late 2003, early 2004. The signal on December 17th is only the 3rd time we've seen a thrust like that going back to 2002. And once again, we're looking at all the data that we have. In the 2 previous cases, stock market was higher 6 months later, 1 year later, 2 years later, 3 years later, and 4 years later. Average gain 47.14%. The average drawdown 3 months out was 2.35%. And it occurred 49 calendar days after the date of the signal. If we go out a year, it's 3.61%. Thus, in each one of these cases, this represents the past actions of some traders. And we all know that charts cannot predict the future. We have to use our own intelligence to draw conclusions about what the past activity of some traders may say about the future activity of other traders. The signals that occurred on these dates where my cursor is moving here were flashed because of the past actions of some traders. Based on the actions of other traders walking forward from these dates, the average one-year return was somewhere in the neighborhood of 12 to 13%. 4 years from the date of the signal, somewhere in the neighborhood of 57 to 58%. If we do some back-of-the-envelope calculations, we can figure out from the close on January 14th of 2021, based on history, the average drawdown may come in somewhere in the neighborhood of 3%, the median drawdown around 2%. Worst case scenario was a drawdown of 8%. Second was a drawdown of 6%. Thus, what we're asking ourselves is, are we willing to tolerate this much pain to get this type of reward 1 year out from a probability perspective? And are we willing to tolerate this much pain to potentially get a reward like this 4 years from the date of the signal? And one of the strengths of the breadth signals off of the low in March of 2020, what followed that low, was they were factually based. The same thing applies to these signals. This has nothing to do with personal opinions, has nothing to do with personal bias. This is all based on facts, things that have happened in the recent past. Helps us filter out opinions and filter out personal bias. And these signals are incredibly meaningful to us because they typically occurred between year-end and January 4th of this year. If we take all of this and put it on a 2021 chart, this is intraday, 12:21 p.m. on Friday, January 15th, these horizontal lines show us the worst case scenario from each study, the worst anecdotal example of the maximum drawdowns. If history repeated itself, it wouldn't be shocking to see the market pull back into this area here. These lines are all above 3650. If that were to occur, we would remain above the Vaccine Monday high here. In two cases, if we went back to the black line or the teal line here, we would retest here, this level here, which would be a natural area of possible support. And we would expect, based on the breadth signals that we saw between the March 23rd low and this June intraday peak here, that the stock market would not revisit this level here. Historically, that's exactly what happened. The June high here should be in the rearview mirror. If it's not, that also tells us something about bearish probabilities. If we put some simple moving averages on the chart, they also give us some guideposts in the short run. It wouldn't be shocking if we stayed above the 50-day in blue, above the 100-day in green, and well above the 200-day in red. None of this represents a prediction in any shape, form, or fashion. This simply helps us understand the probability of good things happening relative to the probability of bad things happening. If the market pulls back into this area here, above 3,500 or a little bit below 3,500, we would be well within the historical norms. If we start to move into this area here, or if we drop below the 200-day moving average for an extended period of time, that would tell us that bearish probabilities are starting to increase. We would learn something either way. How is it possible that the stock market could be 12 to 13% higher in a year or 58 to 59% higher 4 years from now? This slide shows 3 recent headlines from the Wall Street Journal. Common sense tells us when the vaccine starts to impact the economy, growth and job creation should improve in the coming months and years. Once again, we can ask, do these headlines align with or contradict the findings from these 8 studies that we covered in this week's video? These studies provide some additional bull-bear guideposts to manage capital against these 2 objectives. Thus, in summary, the findings are similar to what we've been reporting based on the facts over the past few weeks and months. Even if really good things happen 1 to 5 years out, we have to have realistic expectations about 100% normal and to be expected volatility that can occur even within the context of extremely strong longer-term trends. Thus, the data that we have in hand today allows us to have a longer-term focus as long as the future data allows. And we know the only way that we can interpret that future data is to trade the chart in front of us and to head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.